What's up, everybody? It's Mike. We're back here on the Pitch Please podcast. Today, we're going to be talking about something a little bit different. Normally, we talk to startups about their founders and about what their startups are doing, but we've had a lot of feedback to start talking about how startups are doing and other resources that they could tap into. So, we're going to talk about one that's pretty fundamental today. We're going to be talking about one that helps you whether you're in the ideation stage or you're a Series C, and that's cap tables. And we're going to be talking about why they're crucial to a startup success, a lot about the essentials, common pitfalls, things to think about, things to avoid, how to divvy up your equity as a founding team and as a company with more strategic hires. It's a big topic. And so for that, we brought on Amit from Mantle, who's going to have a great perspective on a bunch of this. But before I tell you more about what we're talking about today, why don't we turn it over to Amit? Tell us a little bit about you, why you're credible to speak on this topic, and a little bit about what Mantle is doing.
Yeah, absolutely. Thanks for having me, Mike. Love the pod. I actually started my career in the engineering realm. I love building things. Back in high school, I got a computer and I'd spend my weekends tweaking Linux distributions. And I'm sure there's a bunch of people nodding along and a bunch of people saying, "What? Like, really? You didn't go to parties?" But that's what interested me. I loved building. And I felt that in my career, moving from the actual software development work to seeing what else it takes to actually build a business, like the marketing side of things, and I got into product management across a whole bunch of different verticals, eventually culminated into becoming one of the co-founders here at Mantle, right? So there's a bunch I can speak to with respect to being a co-founder, but at Mantle specifically, our backstory here is we're a group of people, like 9 co-founders, and we've worked together for well over 12 years. It's actually 13 years. I should update my math on that one. And basically, this is a team who loves building. We've done this for enterprise. We've done this for cloud native things. But every time we went through the startup journey, we felt that cap tables were often managed quite manually. It either was a spreadsheet that was private on someone's laptop, or maybe it's a shared workbook, but even then, key stakeholders are out of sync, right? Like, does your lead investor have the exact same visibility into your cap table as the founder or your lawyer? Good luck if the answer, I'd love to hear answers where that is always yes. And then there's this sort of default state of I've raised a bunch of money, I've got to a price round, and now I've engaged with basically a very overpriced piece of software that is a glorified ledger, right? Like it's got all the record keeping in place, but it's not really helping you. It's not giving you critical tools to plan and look ahead. So we took a lot of that insight. And sadly, we made a lot of mistakes, but you know what? In a unique way that qualifies us to kind of bring a lot of those shared lessons to the startup ecosystem. And that's why we're building Mantle. We've been around for 2 years, and we've had a lot of traction. Happy to get into it in more detail.
That's amazing. And so I love that you're going to be able to bring a super diverse perspective of things you're seeing here. Maybe like just let's start with the basics of like what a cap table is, because I want to make this topic super approachable. I'm sure there's people that are like Series B that hear the word cap table and are maybe too far deep to ask exactly what that means. People that are, not even started their first startup or haven't been in the startup ecosystem for long that don't even know what a cap table is and it feels daunting. So maybe just like explain to us what is a cap table, and then we can kind of bring it up from there and why it's important to a startup's journey.
Yeah, of course. So a capitalization table, or a cap table as it's known for short, is effectively a record, a ledger of all of the owners in a private company. And the first time people hear that, they think, okay, like how complicated can it get, right? Like how many business owners are there? And when you get into private companies, when you get into venture-backed startups, it can really start to get complicated, right? Like you may start with 2, 3, or maybe a handful of founders, and everyone's sort of divvied up the pie in certain percentages, and
33, 33, 33, right?
exactly,
It always
right?
works
So it's
that way.
like, oh, the cap table's in my head. Like I need a piece of software for that. That makes no sense, right? It could be a post-it note, which is just as effective as a spreadsheet. The problem is you start off very simple and then you go through financing and you will jump from 3 stakeholders to 30 stakeholders overnight. And this is very common. This isn't some like hyperbole, right? Because what's going to happen is, let's say you're talking to an institutional investor, they want to write a check. You've got a bunch of other investors who are interested. They don't want to be the lead. They want to write a follow-on check, so on and so forth. You could have friends and family. Founders themselves can write checks into their own company, right? Like maybe they're bootstrapping or they want to get some money in an earlier round. And you take all of that and now you look at, okay, what kind of contracts, what kind of agreements are people signing when the money exchanges hands? You can have convertibles, you can have direct share issuances, and convertibles break down even further into safes and convertible notes. I know I'm using some acronyms here. Happy to get into it in more detail. But what I'm trying to highlight is you go from just 2 or 3 people who are owners in a startup to suddenly having a bunch of different institutions and individuals. Some of them, especially ones who are writing the bigger checks, they're going to put you through diligence. Diligence is a whole process where your law firm is going to work with the investors council and figure out like, is your company in a good place, right? And this is a very open-ended question, but the last thing you want is, as a founder, you're hustling, you're doing these pitches, you're trying to fundraise for your startup, and then it all starts to fall apart when someone verbally commits to you saying, yeah, sure, I will invest in your startup, and then in diligence says, wait a minute, your cap table's a mess. Like, I don't think I can participate. That's not a good place to be. And I can't even tell you how many cap tables we've seen where we, like, the only lesson we can kind of, impart on founders is, I wish you started sooner, right? And that's what a lot of founders also end up saying, right? It's the whole vitamin versus painkiller type of thinking in a way. So yeah, I mean, there's a lot of different things there, but effectively, it is one of the most important assets of that you maintain in your startup. But it also ends up being something that for a lot of founders is always in the back of the mind, right? Like, it's important, but you don't deal with it day in and day out.
Totally. Well, maybe I want to riff on some of that, but one of the things that maybe is worth just clarifying for people, because some people I think would assume that when you have a pie, it's 100 points, and you just start dishing out those points. And you started talking about a few other things there, like convertible notes, other investment tools of how you dish up and divvy up equity in a company. Can you just like maybe give a high level on like the types of scenarios that exist and where or why some of them might be used?
Yeah, absolutely. One of the things that comes up very often is there is a I don't want to use the word misunderstanding, but I think it's important for founders to really understand the mechanics of a cap table. And what I mean by that is, mentally, we have this model of maybe it's a pizza or whatever have you analogy, and you're creating some slices and divvying it out to people. So as soon as we speak to a ton of like early stage founders. Obviously, we speak to the more mature founders as well, and by mature I mean like their companies in a mature state, and they have different questions, different complexities. But with the early stage founders, typically the first time founders, and I've spoken to a lot of like at incubators and such. They'll come up to me and say, oh, my cap table is really simple. It's just 3 people, 33, 33, 33. Or, one's got to be 34, of course. And right there, like, I don't mean to be pedantic, but although that's the right mental model for a cap table, it is technically incorrect. And the reason why it's incorrect is because a cap table has to list the quantity, not a percentage, right? Because it's all about, you have a company, you issue a bunch of shares, and now you start granting the shares to the people, right? So like the co-founders, if you have 1 million shares in the company and 3.33 million go to individuals, that is a correct cap table. Like that if it has the documents to back that up, that's technically correct. Now, the next level of complexity that really trips people up is when an investor joins in, or let's simplify the scenario and say you're bringing on a fourth co-founder, right? So now you're saying, again, mentally, I'm going to go from 33.33, one third per person, to a quarter per person, right? Which is, again, mentally that is true, but then how, like, what happens to your cap table, right? If you got a bunch of people with like 3.33 million each, and then it all adds up to 10 million, you don't have these founders like giving away pieces of their pie and then formulating an end result where everyone ends up with 2.5 million, right? That's not the cap table mechanic. The cap table mechanic, the way it works is you're always issuing new shares. You're always adding shares so that the net total of the new pie, right? If you really want to stick with the pizza analogy, it's like the pizza got bigger and the slices got thinner so that you have four people who now have a quarter each, right? And of course, if you only do this one at a time, it's not that bad. But if you have 10 investors and now you've got all kinds of like liquidation preferences and you got a few other things you got to think about, what order do they come in? What's the valuation cap? That's where it really starts to get complicated. Like, even if you're using a spreadsheet, calculating that math, although it's at the end of the day just algebraic math, it can get into circular calculations and a bunch of different complexities where you'll probably end up on a phone call with your lawyer or on a piece of software like Mantle.
That's a good like framing, and I love the like pizza analogy and the growing and shrinking. But and you mentioned a whole bunch of other things there, which is like nuanced differences in the types of shares and the preferences of shares and who sits where in
Yep.
terms of payout on a cap table that I'm sure are all parts of like the pitfalls, and I'm sure we'll get into that. Um, but when you think about this concept, I guess a question that probably is in people's minds right now, or if not is commonly in people's minds, is okay, if that's going to happen, Amit, do I pre-slice the pizza and keep couple pieces aside in the fridge for later, for other co-founders, for strategic hires, for advisors? Should I be splitting that ahead of time and keeping it to the side? Maybe there's a right, maybe there's a wrong, but it'd be interesting to hear your perspective on that.
Yeah, and this goes back to the cap table mechanic piece, right? It's so, for example, if you are a startup that's incorporated in Delaware as a C corp, so for a company domiciled or headquartered in the U.S., you will authorize a share count, right? So you'll say this company is authorized to issue, let's say, 10 million shares, right? And then you're um, issuing the shares. Maybe you start with like 2.5 million per founder, but there's only three founders, and then you have a little piece reserved, right? That's one way to think about it. But when it comes to cap table math, uh, the percentages are actually calculated on what's known as the fully diluted share account. That is effectively a summation of all the shares that exist in the company that have been issued, right? Issued and outstanding as an active. So this is going to get a little bit technical, but I'm going to try and keep it high level. Effectively, even though you've made a reservation, the reality is there are only 7.5 million issued shares in that particular startup. So when you do your cap table math in terms of like figuring out the fully diluted percentage of those three individuals, you will still end up at one third each, right? From a percentage standpoint. So it all goes back to like understanding the mechanic, which is there isn't really a concept of like reserving a slice per se. There is a carve out, like you could do a carve out for a stock option plan, right? Like founders really should be thinking about what percentage they're going to carve out for employee compensation, right? And we've seen numbers everywhere from 5% to 25%, and typically kind of lands between 10 and 15 for a lot of startups, at least in the early days, right? In the early stages rather. So that's a good example of like you've carved out a specific piece, and from that carve out, you're giving out slices to employees, advisors, board members, consultants, and more.
And at the beginning, you'll basically be less diluted, and then as you give them out, you'll become more diluted to the point of where you thought you would be.
Exactly, because you're always issuing shares, right? And now they're on a vesting schedule, and that's another thing we got to get into, right? So I'll just touch upon this very briefly.
Yeah.
Even in the simplest of scenarios, let's say you have two or three founders that take three founders that take a third each. What if one founder leaves? What do you do? What happens to that one third slice of the pie? Does it walk out the door forever? So this is where, the cap table really starts to become important, because what we see a lot of founders do, and this is one of the recommended ways of, looking at that scenario, is to have it on what's known as a repurchase schedule, or also known as a reverse vest. And effectively, the company has the right to buy back shares if someone were to leave sooner than expected. And the sooner is defined as whatever timeline you've put on it, right? Like you could have a reverse vesting schedule that's 2 years, 3 years, 4 years. And if someone leaves in that window, then whatever percentage they didn't vest, the company can kind of claw back.
Swallow back, yeah.
Exactly, right? So that is something that first time founders may not think about, because when you start early days, it's all optimism. It's all like, I'm going to crush it. I'm going to, take
Everyone's
over
already
this.
counting the millions on that
Yeah, exactly, right?
33.33%.
Yeah, exactly, right? Like you have a working prototype and you're like, this is going to make millions. And maybe that's true. And there's a journey in terms of like really building that up. But the sad reality is a lot of founding teams do end up splitting up. You may have maybe just one person parting ways, and maybe there are multiple co-founders. And depending on stresses of life, startups aren't easy. Depending on a bunch of different factors, maybe strategically people aren't seeing eye to eye. There's hundreds of reasons here. These are the things you kind of have to hedge against, right?
That makes sense. There's one thing I just want to make sure we don't miss it. You talked a bit about carving off maybe an amount that will be for employee stock options, but you blended a few other things in there. And I guess the question would be, should companies be thinking of them as one or separate things? I know it'll all come down to your cap table management, but strategic advisors, consultants, and I guess the ultimate question is, do you always have to give people shares in the company in the same way that you would, voting, non-voting, founder shares? Because I think people are like, oh, okay, consultant. At the beginning, you're just like, okay, I'll give you 1% for this, 1% for this, 1% for this. And then you start eroding pretty quickly. And to your point, that 1% is actually made up of like hundreds, if not millions of shares, depending on how many shares you've issued. And so how do you manage that? And how do you think about these other categories? And what are some of the other categories that you often see in successful startups?
Absolutely. This is one of the pieces that is really important for founders to get right. And unfortunately, we find that there aren't enough resources out there to really help you understand and map it all out, at least in the early days. So you get exactly the scenario you were describing, where let's say you've got two founders and then an advisor comes along, and the founders are thinking, well, this person is really important to us, really strategic. Why don't we give this person 1% or something, right? And we joke about it internally. But like a lot of company equity sometimes ends up being like a roll of toilet paper, right? Like in the early phases, you're pretty generous. You're just using it, and then when you get down to the end of the roll, you're like, okay, one square at a time, and we're gonna split the square further and split, etc. You get the visual. Hopefully, not a real life scenario for folks, but effectively, this there are recommended sort of structures, but there's just no way to describe a one size fits all. It is going to be scenario dependent. It's going to be dependent on the vertical. Are you fintech? Are you health tech? Are you something else, right? Are you building a gaming company? And in each sort of industry, there's going to be a certain set of expectations, right? Like if I'm the very first founding engineer at a startup, I may have a different set of expectations with a certain kind of a company. So as the founder, the flip side to that is you need to understand what those expectations are and what's the best way to meet them. And you also want to be smart about it and understand, is the individual motivated by equity in the first place, right? Like for some folks, they may have the luxury of saying like, yeah, I don't even want the cash. I'll just take the equity. And then on the flip side, you've got people on, basically the other end of the spectrum saying, well, the equity is not going to pay for my mortgage, so I'll just take the cash. And that's okay. So there's a sliding scale there where I think founders should really be thinking about offering a spectrum that is intelligently crafted, right? So, as an example, if you're bringing on an early advisor and you feel like this person is very important, very strategic, is going to stay with you at least for the first couple of years or more, and you're thinking of giving that person anywhere from 0 to 0.5% of your fully diluted shares of your company, then maybe have a conversation and negotiate and understand at 0 this is the cash value, and at 0.5% this is the cash value, and then we'll augment with just actual cash, and then like what's the mix that you like, right? And I think there was a
Yeah.
really famous, the whole Shopify thing of like letting the employees pick. That's a very interesting way of approaching the problem. But I think founders should be thinking about it early, because when you're giving away larger chunks early, there's really no concept of clawback, right? Like you're giving it away. You've put people on a vesting schedule. As long as they're with you, you've given a lot away, and it becomes increasingly difficult to stay fair and to stay even when it comes to future advisor, right? Maybe another advisor comes along 3 months later who's even more important, even more strategic, and now you're like, well, I can't keep giving 1% away to every single advisor. I'm racking up 10, 12 advisors. I've got 6 employees. I've got 6 consultants. Like that's a lot of people, right? And obviously there's a sliding scale where folks who come in early will typically get rewarded with a higher percentage or a higher number for taking the risk in the journey with you.
I like that, and I like the concept of like converting it to what it means in terms of cash, and there's a current state and a future state, and the concept of advisors. The thing that you talked about, and I just want to kind of clear the air to make sure that you could apply it to all these things, which is vesting cliffs. And I think when you bring on, a consultant or a strategic advisor, I guess the question is, should you be giving up like say it's 1%, it's probably less than 1%, but say it's 1%, do you just give them 1%, or do you put a cliff in there because you kind of want them to stay committed for a period of time? And does this fall into one of those like cap table pitfalls where people sort of just give out equity carte blanche, no terms, and then all of a sudden a lot of equities out there, but not a lot of results are coming back? How should people be thinking about that?
Having a cliff period is probably one of the most important considerations when you hand out equities, specifically options, to anyone. And a big part of it is, you can think of it, if you just do it based on a time basis, like let's look at like a typical Silicon Valley startup. They're gonna start off by thinking 1 year cliff, 4 year total. Okay. And what that means, if you really break it down, is from the day the company grants an employee options, for the first year, for the first 12 months, the person actually gets 0. And then right after the 12th month, the person gets 1 year worth of options in their name. And then from there on, it's a fraction, like 1/48 monthly thereafter, right? So you're getting tiny fractional pieces from the end of year 1 to the end of year 4, right? That's just one example of a vesting schedule. So you can obviously adapt that, right? As an example, we'll see advisors will typically get a 2 year schedule. And maybe the cliff, in that case, a cliff period may be a bit tighter, 3 months or 6 months or something to that effect. But you want some kind of a buffer, right? Some window of time where you can work with the person, make sure things are going well, so that if it does not work out, and on either side, the individual decides to part ways, then they're not walking away with tiny slices of the pie every single time you hire someone, right? The other consideration here is vesting schedules are not just time based; they can be performance based, and we see this a lot where you'll get a company saying, well, we're bringing on someone strategic who's going to help get this medical thing approved, right? So that's going to be a performance-based metric where if it gets approved, you get like this large chunk of options. Or in a retail scenario, if you open X number of stores, or you expand to X number of states and provinces, then you get a bunch of different options, right? So it's all about aligning incentives, right? It's one thing to say that everyone who's working in this company or working for this company They're obviously incented to grow the pie collectively so that we all win and benefit. But part of that alignment is you don't want to reward people simply for sticking around. I mean, that's obviously a very big part of it, right? Like 80% of
You want
a
them to
lot.
be productive while they're sticking around.
Yeah, exactly, right? Like showing up is a really big part of it, and being there and grinding and crushing it every single day, but also delivering results, especially specific results. If someone's brought on to do a specific thing, is important to consider.
I love it. So, Amit, you talked about both shares and options, and I'm sure some people understand this, but a lot
Yeah.
of new founders, and I'm sure even founders that are deeper in, just haven't kind of sped through it and bullishly went through it. But to help people really understand the difference, can you just explain the difference in when one would or wouldn't be used?
Absolutely. This could require a lot of time, so I'm going to do my best in summarizing at least the headlines of it, right? So, shares in a company are basically fractional pieces of the company, right? And a share issuance is something that you would typically give to a founder or an investor in exchange for investment dollars. And there are some mechanics, for example, you can have a convertible that converts to shares at a future point in time, but at the end of the day, the investor is going to end up with shares in the company, right? So it's the actual fractional unit that adds up to the totality of ownership in a company. An option is basically a security. It is I guess you can think of it as a financial instrument that gives you the choice to purchase a share in a company at I don't want to say discounted price, but at a price that is set in the early days. Or specifically, it is set on the day the option is granted.
Mm.
So if I get hired right now to work for some startup and they give me an option agreement to sign, it may say something like, I get 10,000 options at a strike price or an exercise price of 2 cents, and it's on a 4 year vesting schedule. And then if 4 years go by and I decide to part ways with the company, at that point in time, I have vested my entire 10,000 options. It's still not ownership in the company yet, but I have the choice to translate that by paying 2 cents a unit to get 10,000 shares in the company. That's called exercising. And of course, you can do that during the vesting period, but I'm just simplifying the example and saying I would just
Yeah.
do it once at the very end. And now I'm a shareholder and I have 10,000 shares in the company.
Got it. So it's like giving out that 1%, but not because you're saying you have the option to eventually buy your way into 1% at a really, hopefully better price, but you might choose not to do that. So I haven't fully given that 1% away because there's an option for them not to take it, depending on the vesting cliff or their desire to buy in,
Exactly.
depending on how
Yeah.
the company is doing.
Yeah, because an employee or whoever, when I say employee, I mean any option holder, right, could forfeit, like they quit or part ways, company part ways, and then the person does not take advantage of what's known as a post termination exercise period. It's typically a time window given to folks at the end of their employment or their contract. You get maybe 2 or 3 months, sometimes 6 months to make that purchase, and if you choose not to purchase, then you've effectively forfeit and those 10,000 units would return back to the pool.
Got it. Well, I think now, we haven't even gone all the way into all of the permutations and things on a cap table, but I've already very quickly come to realize, and I hope others are too, how difficult managing all of this in a spreadsheet would become because there's not just share points. Share points is like the smallest piece of this. There's who is owed what? Is it an option? Is there a cliff? Is there money in? Is there money out? Has it been exercised? Has it? So maybe like let's take a quick pause and before we start maybe talking about managing a cap table, maybe give a high level on like where and how Mantle is solving some of this. And then I'd love to like just talk about actually doing the managing of that cap table because it'll flow really nicely.
Uh, sure. For Mantle, our primary vision when it comes to cap tables is it's all about the past, present, and future, right? From a past standpoint, you as a founder You've granted shares to other fellow co-founders. You've granted options to a bunch of different individuals and institutions, and you need a place to track that. Present is where you are today. What does your cap table look like right now? And to your point, if you were doing all of this on a spreadsheet, just imagine the complexity. Like, even if you just have a handful of employees, but they happen to have different vesting schedules, obviously they may have a different vesting start date because you hired them at different points in time. And now you're creating this calendar based schedule in a spreadsheet per person that's showing what's known as a vesting tranche. So it is the individual slice of how many units the person is getting on a monthly or quarterly, whatever the schedule is, basis. And you're adding it all up at a point in time and saying, okay, as of today, this is where I am at right now. So you can already start to see why a piece of software would make sense to track something like this. And then the
Yeah, it'd
future.
really suck if your VLOOKUP function fails in that spreadsheet and you start dishing someone 10 million shares instead of $10 million of total value, or some vice versa, right?
The mistakes we've seen, I can't, like, it could be a real mess. And it is painful, it is expensive, and it's also very expensive to fix, right?
Mm.
Like, imagine having the conversation where you granted someone a bunch of options, maybe you made a mistake, and now the person's been vesting for months and months and months, and now you have to get into a room and say, hey, you know what, there was an extra zero in your grant. How do we fix that? Like, you've already vested for 6 months, and there's all these, like, it just, you don't want to get into this, right? Like, it's not a fun conversation to have. Even if you have to correct it, you got to figure out, like, okay, what does that look like? It's an option amendment. How do we, like, recapture some of it? Do we expand the entire pool to dilute that person and recompute all the slices? Like, the solutions are endless. But they're all time consuming, and you're a founder. You want to build, you want to grow, you want to sell. So you're sort of taking time away from your core value prop in your startup and doing this other thing, which is very important, but in a way you wish it was kind of automated and well taken care of and well managed, right? So that's something to consider. And then the third piece for Mantle is the future piece. And this is something we absolutely do not see in the market, like, especially with the competition, is you've handed out equity, you've got your current state, you can see where your cap table is at right now, you can see the dilution, like, what percentage of the company do I own as a co-founder? Important question to ask and understand what that looks like over time. But how do you be forward looking with this stuff, right? How do you say, well, we are expanding into a new market next quarter, so we're going to hire a bunch of people. One of them is going to be an executive, and I want to be able to hire them all and grant them equity at a certain number. Do I have enough room in my option plan? How do I get a visual? How do I project ahead? The scenario modeling, this is where Mantle is effectively a super tool, where you're not just recording stuff, you're looking ahead. Or you're thinking about, maybe you're having a conversation with an investor, right? Like, you go to a networking event, investor says, your company looks interesting. We're the type of investors who typically do an A round or a B round. We'll put in checks between 1 and 5 million. Would love to hear more about your startup. Now, you have a couple of choices with that information. You can email your lawyer, or you can find some spreadsheet templates, start doing what's known as a pro forma or as is cap table calculation. If you've never done it before, I assure you it's going to take hours. It's going to be painful. I've done it myself. It is not a fun exercise. But then you could use a piece of software like Mantle. We already have your existing cap table, and you can just go in and quickly model and say, okay, hypothetically, if that investor from last night, that person said 1 to 5 mil, maybe let me do 2 million. And here's my valuation cap, because I know where my company is supposed to be. Maybe I've done a 409A valuation. Maybe I had a previous round, so I can use that as an anchor value and maybe add some percentage to it. And you as a founder, you have a pretty good sense of, what your startup's going to be valuated at. And I can get a pro forma cap table in seconds, right? Like I can
Wow,
instantly
that's
see
powerful.
that type of a deal will dilute all of us. And remember, when you take on new investment dollars, all shareholders, all option holders get diluted, right? So all of us collectively are getting diluted, let's say 10%, 15%, 20%, or is it 50%, right? And then you have to understand what's a good deal and what's worth pursuing. So it makes you much more intelligent, intentional, in real time in those conversations.
So across all these, what are some of the common issues or pitfalls that you see? And in contrast, where and how do they have a difference? You talked about raising funds a couple times here. So I imagine they go hand in hand with lots of things, but I imagine pitfalls really fall short when fundraising. So what are some of the issues or pitfalls that you see, and where or how or why can those get you into trouble when you're fundraising?
There's a lot here. If you think about one of the most important things a co founder can do, especially if you're the CEO, but this really applies to all co founders. You're building, you're selling, you're recruiting, and there are, obviously many other functions, but you're also fundraising. And in a way, you're fundraising all the time. Even
Mm.
if you just fundraise, you just closed a round, and now you've got money for years, that's okay. But be ready for the next phase, right? Like always be thinking about where is this company headed? Where's our product going? What's the next big thing that's going to happen? And you don't want to be in a position where you realize that, hey, we have this big, fantastic opportunity. Maybe we can expand to a new market. And an influx of cash right now would be fantastic. That's not the best time to go out and try and drum up investor interest. This all goes back to just basic networking and relationship and partnership building type of work that it's a lot of groundwork, but it's important work that needs to get done. And from there, you get into the pitfalls of it. There are a lot, right? Like the first one, kind of I alluded to, which is if you're not thinking about fundraising, then you might be behind, and that's not a good place to be if you're negotiating at a point of desperation, or you're like, you've got less than 6 months of runway left, then
Yeah.
you're probably going to take on a deal that isn't as founder friendly as maybe if you had much more leverage.
Mm.
Obviously, try and fundraise when your company's on the up, like up into the right end of the graph and the spectrum in terms of like any kind of growth and traction you can showcase. But more importantly, if you get into the specifics of it, the type of deal you sign on is very important to consider, right? So if you're working with an institutional investor and they're very interested in you, they'll probably send over a term sheet, and that term sheet will effectively break down the high level deal terms of what it looks like for the investor to write some money into your company. And it will have things like the actual dollar value that you're sort of allowed to raise. So it could say something like, you are, as a company, you're thinking of raising, let's say, $5 million, and off which 2 million will come from the lead investor, and the remaining will come from follow-on investors at a certain valuation cap. Maybe it's 40 million, 50 million. Higher the better, obviously, for you as a founder, but then there's trade-offs, like
Yeah.
too high and then you've got a problem on the next phase, etc. um, Maybe there's a discount rate, and then you really start getting into it. There's liquidity preferences, there's conversion ratios. I didn't even talk about share classes early on, but that's another consideration of like, oh yeah, founders get shares. What kind of shares, right? Like a lawyer's going to ask you that, like common shares, preferred shares. What are the voting rights? Is there a
Yeah.
voting multiplier? So the list goes on, right?
Let
And this
me
is
flip through
why,
the tabs on my Excel and my
yeah,
OneNote and my, yeah.
exactly, right? And then months go by and you're trying to figure out like, wait, who's the lead? Who has the largest percentage in this company? It's not me, the founder. How did that happen, right? So those are the types of unfortunate horror stories what we'll see a lot of. And then every funding round, you don't want to give too much of the company away.
Yeah.
Obviously, that's a relative term, but there are some really good write-ups on sort of the uninvestable cap table that I'll suggest listeners take a read through if they're interested to go deep on this topic, or just reach out to us. We have this conversation with all our clients because we're going beyond just being a software provider, right? Like you can call us, you can talk to us, and try and get maybe an unbiased opinion or some data points on here's what I'm thinking, here's what my cap table looks like. Obviously, we're not a law firm, we're not an accounting firm, we're not giving out legal and financial advice, but what we're giving you is data points, because the founder to founder level advisory is a giant gap in the market that we haven't seen. And when it comes to the pitfalls, I mean, I could just enumerate hundreds of them, but I think what's more important is for a specific deal, for a specific founder and a specific startup, we just got to look at it with a magnifying glass and just make sure that things make sense.
I love it. So, I mean, where and when do you feel is the right time in a startup's journey to start really getting a handle on managing that cap table in a more sophisticated way? Because I would say Mantle versus like an Excel table would be considered a more sophisticated way. But, for someone on the outside, they might be like, ooh, that's an extra cost. It sounds expensive.
Right.
And so maybe it's not that expensive and maybe it is very accessible to people. So it'd be good to talk about that a little bit of like, what is the basic version of Mantle for people, and where in the journey do you recommend they get started on thinking about a more sophisticated way of managing their cap table?
Absolutely. The perception of cap table management being expensive, painful, was true. And that's a big part of our motivator in terms of building this platform, right? We've made it far more accessible, founder-friendly pricing. It's flat rate. You don't have to pay per seat. So in a way, we're biased. We're always going to recommend you get started sooner rather than later. But let me give you like one of the most common scenarios we come across, right? And we've seen this in hundreds of clients now. A founder will start off with a spreadsheet, and sometimes they'll just defer to their law firm, and that's okay, right? Like the law firm is going to do a pretty good job. It may not be real time in the sense that you're issuing options and maybe the law firm doesn't know about it because you just went rogue and sent out a DocuSign and got the signature, and now it's sitting in Google Drive somewhere, and you don't even remember where it is, and your law firm doesn't know. So all this activity will happen, and then the founder tries to close a round, right? Let's call it pre-seed, let's call it seed, doesn't matter. The institutional investors doing diligence. That is a pretty important and stressful period, right? You're trying to close, you're going through a lot in terms of negotiating, figuring out the deal terms. Maybe you're doing a roadshow. You're going across city to city, you're talking to a lot of institutions. At that point, you will realize, I really need that cap table. So for a lot of founders, that is the time when they adopt a piece of software. So
like right before money raising kind of thing. So
exactly.
Like when you're going to start taking money from outside of the core founding team, even maybe when you are from the core founding team, but especially before you seek out additional money and things are about to get complex, super good timing to think about this.
Exactly. And that's when it flips from being optional to almost mandatory. I say almost mandatory because yes, there's always the edge case of someone being super organized in Excel and being like, I spend 2 hours a week on this and I get it right, and that's okay. But that's where you wish that you really needed that piece of software to keep you organized. And then we'll get founders coming to us saying, I'm trying to close this week. Can you get me set up ASAP? Right. Oh, by the way, I also need a 409A valuation because I handed out all these options and I gotta, figure out what the valuation is, et cetera, right? So there's always this kind of scrambly catch up that a lot of founders have to go through. And what we're trying to get at is avoid the stress, avoid the mess, get organized on a platform like Mantle, like our founder-friendly pricing. It's no more expensive than probably most pieces of SaaS that people are already paying for. And then it's one less thing to think about. And it's one important thing where when you're going through diligence, you could just tell the law firm on the other side, here you go, just log into my Mantle instance, grab whatever.
That's cool. And so if people are curious, it's with mantle.com, correct? And they
Yes.
can request a demo, figure out more, get started. But if you not don't wait till you're about to raise money. That might be too late. Get ahead of that moment where if you think you're going to raise in probably what, the next 6 months, probably a really smart time to consider reaching out at a minimum.
At a minimum, for sure. But another way to think about this is, I would say, just get going as soon as you incorporate,
Mm,
because as an example, we'll happily extend a special offer to your listeners, but effectively, you may like you don't have to pay anything for the first year.
mm,
So that way you incorporate, you get set up, and then between month 0 and 12, if you are thinking about a raise, you're already organized. And now suddenly maybe you have a friends and family or an institutional investor who says, yeah, I'll give you a small check now just to like get you going, and then let's really talk about a proper round and constructing
yeah.
all the participants and everything. And instead of like throwing that into Google Drive and losing track of it, like just get it into Mantle.
Yeah, I love it. Well, Amit, this has been like super helpful for me. I've learned a ton, even though I kind of know quite a bit about this space. I hope the listeners have too. I'm sure there's still lingering questions, but these are supposed to keep those lingering questions so you reach out and stay curious, find out a bit more. But before we wrap up, any closing thoughts on your side or things that maybe we didn't cover that you think people need to hear when we talk cap tables?
I think we've done a pretty good job in terms of like speaking to the importance of cap tables, and just how many important and major steps founders have to go through in their startup journey to get things right, or at least get things aligned in like a good general direction. One of the important things here is, like I said, with mantle.com, go over there, book a demo. You'll speak to me directly, actually, and we're here for you from a founder to founder level perspective as well, right? So if you're considering alternatives, that's something that you're gonna probably not get a lot of. Good luck trying to talk to an executive at at some other larger company. I guess maybe the last piece I'll leave founders with is there's all this founder advice out there which is very applicable, right? Like you have a bias to action. But one of the pieces I'd love to share, and this is a rehash of what you'll see Naval say a lot of, which is he says it he says it in context of hiring someone, right? Like as a founder, you're hiring uh, good people who have a high sense of agency. And by that, what it means is folks who seek out problems, solve them, and then just keep going, right? Like you just point them in a general direction and they get things done. And I think founders realize that inherently, that they have to be good. They have to have a very high level of agency for themselves,
Mm,
right? So this, in a loose way, ties into that territory of like, uh, don't let your cap table languish and get to a point where it's so painful that you're spending tens of thousands of dollars in legal fees to get things corrected, to get all the documents signed that you missed, to get things organized, to dig things up, et cetera, et cetera.
Well, super appreciate the dialogue today. I know our listeners are going to love this one. I'm going to re-listen to it, make sure I really know my stuff on cap tables for whenever startups come reaching out to me. I know where I'm pointing them. Thanks again, Amit, for joining us today, and we will talk soon. Thanks for everyone that tuned in.
Yeah, thanks for having me on the pod, Mike. Take care.